So the massive moves in the markets today, what do they actually mean? Well, they're very much short-term noise. What the chairman of the US Federal Reserve has said is that he anticipates rate cuts in the US in September. Why would that buoy up the market so much? Well, first of all, we're greedy in the stock market. We quite like more money coming into corporate hands and less going away in interest payments. And similarly, more money going into corporate hands through consumers who have more money to spend. Very simple. Interest rates go down. The stock market is happy under these current economic circumstances. The Fed could change its mind in October because it could argue, well, the impact we wanted from lower interest rates of increased consumption, greater investments, has already been brought about by us announcing it, and therefore we don't actually need to cut rates and let's drag it out for another month, which in actual fact would end up being good for the markets because it's like a carrot at the end of a donkey's nose. It's just being led further up the hill, which is perfectly fine. The market's being led up the hill. So what is driving market movements upward other than that sentiment, despite the fact that tariffs should presumably be moving the markets lower, particularly tariffs leading to uncertainty, and the markets, as we know, don't like uncertainty. Well, the other factor moving markets higher is earnings, corporate earnings. Now, on Wednesday, NVIDIA have got their profits announcement after market close. But well before that, in the last couple of weeks, we had all the major companies in the S&P 500, the 500 largest US companies, announce their earnings. And the most important movers in the S&P 500, which is actually a portfolio of 7 companies, the Mag 7, because it's market capitalization weighted. In other words, bigger the company, higher the weighting on the index. And there's only 7 which pretty much run that whole index. If you don't own them in the same proportions, you can't beat that index. It's a simple mathematics. Those 7 are exceeding profit expectations. So how is it that they keep exceeding the expectations of profits? And why are expectations so important? Well, the market isn't about you beating a number and therefore you going higher. That would be obvious. Everybody would get rich. It's about the next chess move along, which is we already anticipated a higher number that you should beat. And if you don't do that, then we're going to think one step ahead, which is the other guy might sell off the back of that, so we'll sell before him. Are you keeping up? Essentially, the bottom line is the companies have been rather good at 2 things. One is managing expectations. You know what I mean? If you've got a dumb boss, you're good at managing expectations. And secondly, at jumping over those expectations to begin with. As long as that game of musical chairs or the Pied Piper keeps playing the music, we're fine. Is that about to diminish? Doesn't look like it, but the problem is that's very hard to anticipate as well. Hard to anticipate at an individual company level, but a bit easier at a broader level because one company or one swallow does not a summer make. Similarly, one company having a disaster does not a bear market make. At the moment, most companies are simply not having a bearish time. More importantly, the 7 big companies in the S&P 500 are not. And that's really what makes all the difference. Got it? I hope that all made sense. Like and follow for more, subscribe for more content, or have a look at alpeshpatel.com/links to learn more about investing generally anyway. Thank you very much.